Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Treasury yields hold losses with the yen gaining as data showing a U.S. labor market slowdown. They're backing the case, perhaps, for supersized Fed rate cuts. Now, Chinese equities facing darker prospects after a weak earnings season, and now you have JPMorgan dumping its bullish recommendation on worries about a renewed U.S. tariff situation. Also ahead, Beijing considers cutting interest rates on $5 trillion of mortgages in an effort here to boost demand while also shielding the banking system.
And I'm Stephen Engel in Beijing, where President Xi Jinping will momentarily lay out his plans for growing relations with Africa as China's economic slowdown and, of course, debt issues in Africa blunt, perhaps, its lending capabilities.
All right, there is a typhoon in Hong Kong, and we take a look at when it comes to markets. It's looking a little bit less turbulent in the last few days, although you take a look at what's been going on with this yen rally and what's going on in treasuries after that U.S. JOLTS data. So it was the weakest print we've seen in terms of job openings since 2021. So how does that set us up for the U.S. jobs report that is supposed to land on us on Friday as well? So that's why you're seeing a big bid over sovereign bonds in Asia here this morning. There's a big move in the yen as well. We were gaining as much as 1%, and now we're seeing a little bit of steadiness, but still we're trading around 143.68 levels right now. Stocks are a bit up there, but you're really seeing that stronger yen really impacting the Nikkei 225. We're slightly down by 0.6%, but other markets here in Asia are faring okay. Taipei, look at that. We're seeing a rebound of 1.3% after the rout yesterday, but Nvidia extended that plunge overnight. Worst two-day plunge we've seen in 2 years for that stock. What does that mean overall? But it seems like Taipei is faring well here this morning. You take a look at the Bloomberg Dollar Index. We're pretty much flat here right now. But right now we're watching very closely oil markets. So that's been down some 1% in Shanghai crude, reflecting what we saw across Brent overnight as well. We're at 72 for Brent here this morning, and we continue to watch iron ore. We're getting closer to $90 now for iron ore. Dalian is certainly feeling those futures as well, down about 1.8%. We'll talk about the growth downgrades in a bit here from BofA. JPMorgan, obviously that call when it comes to China stocks and really abandoning that overweight call on some of these U.S. trade risks as well. But treasuries are doing this here right now. So we basically have seen yields fall. I mean, the whole yield curve has basically shifted lower to those year-to-date lows right now. In fact, you take a look at the U.S. two-year yield, that's at 376 levels, which is basically back to levels that we haven't seen since 2022. So the weakness in the labor market certainly is very, very telling here of what this means, and bond traders are certainly very sensitive to it now. And we're basically watching at one point that yield curve did uninvert for a little bit too, Dave. And we're watching the approach to the open in China as we talk about these downgrades. The macro picture seems to be looking worse. What's really going to turn this around? We'll talk about JPMorgan's call in just a bit here. But yeah, futures are flat this morning, Dave.
Yeah, we didn't really get the earnings season to support these, I guess, a catalyst to take advantage of these cheap valuations for now. So we'll unpack that story. To Yvonne's other point on the Fed, right? So we now have 10 rate cuts of 10, priced all the way until the end of the cycle, going into about mid of 2026. That's the current number based on Fed Fund futures. That changes, obviously, going into as we move things along. Right, going into today, so one level we're tracking, specific level we're tracking on the CSI 300 is just below the 3180 level. So we're about 3% from that point. Below that, we're back to the lowest since 2019 in terms of onshore rates. We're just also getting oil prices coming online in Shanghai. That should be coming up on your screen shortly, following 2 days of fairly steep declines in oil prices. In terms of earnings coming through, NEO, and, of course, a big developer here in Hong Kong, Sun Hung Kai, following that profit warning which came out of New World earlier in the week, which really further depressed some of these prices as well. President Xi Jinping is set to speak at some point this morning. And, of course, we're also, as Yvonne is pointing out, on weather watch today as that typhoon is barreling towards southern China. And, of course, here in Hong Kong, we have a T3 that is hoisted over the city. And we did just get word about just over an hour back that a possible T8 signal will be hoisted later this afternoon, which effectively means if that continues all the way to this time tomorrow, it might affect the opening of markets, but we can worry about that later today. In the meantime, though, the big story, of course, is this JPMorgan decision to abandon that bullish call.
Yeah, so they were overweight and now basically downgraded to neutral. It's interesting what they said, what the reason behind it was the trade risks.
Yeah.
Because when you talk about tariff war 2.0, it's what they're calling it right now. This is when you're talking about maybe a potential Trump victory, where tariffs increasing from 20% to as much as 60%. They're saying that could have a more significant impact than the first tariff war. And it's really difficult, they say, to really model this right now, of just how much of that equity risk premium you can put across these markets.
Which is why that premium exists and continues to exist. And I think later on in the show, we'll be joined by Goldman Sachs Asset, and they actually think India, as many have pointed out, is the way to play that, the structural shift into Indian markets. I think 60 is the new target, I think, on MSCI.
From Wendy Liu.
From Wendy Liu.
And her team, yeah.
On MSCI China. The other trade recommendation that's being put through is on cheap valuations is this call spread, and I think it's Bank of America that's actually put that out there on the Hang Seng China Index. I think it's 6,500, 7,000. In other words, because of how cheap call options are, because of how cheap the markets are, we'll need to see a rally of about 13% on Hang Seng China for that to actually pay off to about 500. So that's about a 37% upside. And I guess just to underscore how cheap this market has become, when you compare this to the S&P 500, priced at about 40% of what the multiple is on the S&P 500. And it's not just cheap in itself. It's cheap relative to history, to its 2 standard deviations where this ratio should be. And a lot of this comes down to the fact that we are not getting any sort of impetus and growth. In fact, the last couple of weeks have seen a number of banks have come out and downgraded their growth forecast in China.
Because last week was UBS, JPMorgan, BofA is the latest one to really kind of cut their growth forecast to 4.8%. So I think almost every bank now doesn't expect that growth target to be met this year. So it just goes to show how this pessimism is spreading here right now. Let's get to one of our top stories here as well. With Bloomberg sources are now saying that China is considering cutting interest rates on home mortgages in 2 steps to lower borrowing costs for families while mitigating the profit squeeze on banks. For more, let's bring in Min Lo, our China correspondent, with more on this. And how big of a cut are we looking at now?
So what we're learning from sources is that the regulators are looking to cut mortgage rates by a total of 80 basis points in 2 tranches. So the first tranche would come within the next few weeks and the second tranche at the beginning of next year. And the intention of this 2-step process is to reduce the blow to banks, which, you know, who have had their profit margins really hit by the weak economy and the fact that Beijing is leaning heavily on them to provide cheap loans to consumers and cash-strapped developers. So our Bloomberg intelligence team is saying that it would really hammer the bank's margins by about 10 basis points. Citigroup wrote in a note that it could hit their margins by 8 basis points next year and hurt earnings by 6.4%. And right now, if you look at end June, the profit margins are at 1.5%. That's significantly below that threshold of 1.8%, which is the level that we deem is necessary for a reasonable profit margin. So again, the banks are going to be asked to do the heavy lifting to help revive the economy here. Yeah,
national service, as they call it. What is the current impact on the housing and consumption that's being penciled in? What are you hearing?
Yes, so the existing home loan mortgage rate is about 4.27%, and the new home loans are at about 3.45%. So the difference there is about 80 basis points. So if the regulators cut the mortgage rates, it's going to erase that difference. So it might slow down the rate of these early repayments of mortgages, which we've been seeing a lot of because consumers are just taking advantage of the cheap consumer loans to pay back their mortgages early, which, by the way, is not legal. It's banned by the regulators. So it's going to save about 300 billion yuan annually in terms of interest payments, and that translates to about 0.6% in retail sales, 0.2% in growth. But again, that's assuming that the borrowers take all that money that they save and spend it rather than put it in their savings. And so that's the estimate so far. But previously, I mean, last year we saw cuts to mortgage rates as well. It didn't really do a whole lot to boost consumption and home sales. So this Bloomberg Economics is saying that it's big, but it might be immaterial.
All right, Min, thank you. Min Lo there, our China correspondent. And as we mentioned about that BofA call, right, so 4.8% for the China growth picture, but they also overall cut global growth with their forecast here from 3.3 to 3.1%. Here to talk us more about that is let's bring in Claudio Irigoyen, head of global economics research at BofA. Claudio, it's really great to have you here in the region. Walk us through just behind these revisions.
Yes, we have reviewed slightly downward the global growth forecast to 3.1% from 3.2%. This is a bit better than the 3% we had last year. We expect 3.3% for next year. So the global growth picture doesn't look like worrisome, although downside risks are higher than the time we did the mid-year review about 3 months ago. When you dig deeper into the different regions, that's when you see different stories starting to play out.
And the drag is mainly from that cut that you guys delivered in China?
Correct. We revised downward to 4.7% for this year and 4.5% for next year and 2026. The main driver there is a combination of two factors. Consumer confidence remained depressed, and there is insufficient policy support, both monetary and fiscal, for a combination of reasons. And therefore the consumer starts to feel that property prices might continue adjusting downward and precautionary savings remain high.
And I'm just wondering what are going to be the growth drivers then? I mean, at least this year, I think exports was the key sort of pillar.
Correct.
That looks to be a bit challenged now.
Yes.
Do you see that next year? I mean, given the base effects and all, what are going to be the big growth drivers if exports are starting to falter as well?
Well, it's going to be a combination still of exports and consumption. It's simply the case that it's going to be more difficult to achieve the targets of 5% that the authorities have unless we have more policy support. Remember that the policy support is a little bit, it's quite a bit endogenous in the sense that if we have further slowdown, it's more likely to have policy support. If the slowdown does not materialize significantly relative to our current forecast, maybe authorities say, well, I mean, those numbers are not that bad, it's okay. It doesn't justify the cost of additional policy support. You know that if you weaken or if you do monetary policy in a sense that might weaken the currency substantially, that might bring other problems. Fiscal policy has been an issue between federal and local governments. So everything that you do has costs and benefits, and obviously the further the deceleration in growth, the higher the benefits of really moving policy forward significantly.
You know, that's a very good point you bring up, because the point, I think the revision you guys did was to 4.8% growth from, I think, 5%, if I'm not mistaken.
Yeah.
The difference would be if it went from 5.3, for example, to 5.1, and the difference from 5 to 4.8 is that now implies they might miss the growth target. And I'm wondering whether that, whether the street thinking 4.8%, might that spur more stimulus or more a policy offset that would otherwise have not been the case?
Correct. Yeah, that's basically the tug of war that you have all the time. When the market becomes too pessimistic about China, you have to take into account that the further the slowdown, the more likely the reaction function of the government, and then is when you have the positive surprises. So you have to monitor all the time, high frequency, how the economy is evolving and how authorities might react to the slowdown of the economy, because they have room to do more.
Okay, Claudio, more with you. In a moment, of course, we still have, I think, the Fed to talk about the issue of that, too. Head of Global Economics Research there at BofA, just rejoining us in a couple of minutes. Counting down to the open of trade here, just under 16 minutes away in Shanghai, in Shenzhen, and here in Hong Kong. You're watching The China Show. Right, welcome back to shows here. Okay, quite a milestone. Your reference rate for the day now has a 709 handle, which would be, I'm just looking at my graph and chart here, which would be the first time we had a reference rate of this sort at about this level here, going back to early May. So that's about 4 months from now. And as you can see, the currency is also adjusting ever so slightly to the parameters of the playground today.
Yep, and it's really that dollar weakness that we've been seeing after that JOLTS data out of the U.S. as well, and really has moved this Treasury market. If you take a look at what we've been seeing across the curve, we mentioned about basically the entire curve is at year-to-date lows, but in particular in the short end, we're seeing the two-year yield at those two-year lows here right now. So it looks like things are now looking a little bit more steeper, to say the least. But yeah, Fed cut bets, I think it's still about I think a 30% chance we might see a 50 basis point cut.
35 basis points is priced.
But there might be a chance here, just given the soft labor day that we got overnight, that those bets are basically boosted a little bit here. Yeah, leading up to the jobs report.
Yeah, well, let's get the sense of what that Fed cut looks like. And I think more importantly, though, how deep the Fed gets in the upcoming cycle. Joining us still here on set is Claudio, Irigoyen, head of global economics research at BofA. Do you want to talk about this upcoming Fed decision, or do you think it's 25? Likely 25?
That's the forecast we have,
okay.
25, and then clips of 25 every other meeting until reaching a terminal rate of the range 375, 350. But as you mentioned, I mean, the payroll number is important. A negative surprise can lead us to rethink those forecasts. 50 basis points in the first meeting where you start the easing cycle is a little bit too much. There is a number that might justify that reaction function, but I think the option value of waiting for the Fed and seeing more, it's enough. You can start with 25 and then do every meeting instead of every other meeting.
Right.
And then you see how the rest of the upcoming uncertainty with US elections, etc., play out, and there you go from there.
You look at what the Treasury curve is pricing in, though. I mean, are they just kind of overdoing it right now? Are they forecasting a bit more of a steeper slowdown than what you're suggesting?
Well, we are in the soft landing camp first, so we are not forecasting a recession. That means that if you compare our forecast for the Fed relative to the market is thinking more of a terminal rate close to 3%. Unless you have a recession, the market has priced to perfection the easing cycle. There is a lot of discussion about what the R star or the terminal rate should be, and we are more on the camp that in that range of estimates that it's a bit on the high side. So yeah, I think the market overreacted to the prior payroll number. That was a bit distorted by some weather issues. And it's ironic, if you take a look at the dynamics of the bond market and the stock market, when you had the payroll number and a few other negative surprises, that was a month ago. In that month, the stock market recovered pretty much the whole correction, and it's now trading higher than that day. The bond market went from pricing 50 basis points of cuts for this year to pricing 125, and now it's about 100 for this year. So it was a very asymmetric reaction of the bond market and the stock market.
Yeah.
Since you mentioned the U.S. elections too, I mean, do we know enough about each candidate, for example, to determine whether or not what economic policy might look like, and whether that would be reflationary in some sense? I'm trying to get to the fact that the last elections, when Biden came in and then introduced, of course, during the pandemic, that massive fiscal stimulus, we ended up with an inflation problem we're still feeling today. And I'm wondering what the tail risks are on inflation from maybe both sets of policies, if there is enough information.
Well, the first thing I would say on that is that we are learning every day on the platforms of the candidates. Right. There is an important first debate on September 10th. We're going to learn, I think, a lot from both candidates. And I think the markets are quite reluctant to jump into the election trade yet. It's too early. The market has been focusing more on whether the Fed will start cutting, by how much, etc. As we approach the election, we're going to have more information, and that's when the market will start position for that. What the market acknowledges is that it's an event that will bring uncertainty, and they will react accordingly. One thing that is important to highlight is that this world and this U.S. economy is different from the one that Trump inherited in the first mandate and the one that Biden inherited in this administration. So we are talking now about a fiscal deficit that is record high. So if you have a Republican sweep or a Democratic sweep, that could have implications for the deficit. 4 years ago or 8 years ago, the fiscal accounts were more in order. So that changed a lot, the balance of risk and the policy options that you effectively have.
Do you agree with what JPMorgan is saying about this tariff war 2.0, that it could actually be much more significant to global growth than maybe what we saw in the previous administration?
I think it's too early to tell. Politicians during the campaign say a lot of things that might be different from what they have to do when they have to effectively run the country. Remember, this election is important because not only who is the next president will be important, but the composition of Congress will be important. It's not the same to have a sweep on either side than to have a divided Congress. There are some tax cuts that will expire at the end of next year that need to be renegotiated. So this idea that you can set different dimensions of the overall economic program in isolation, it's not true. You have to think about the comprehensive program, and you have to see how different policies interact with each other. So I think it's too early to jump into the conclusion that it's going to be one way or another.
Just to round up your report, the headline is lower growth on a global basis, but there are some bright spots like Japan and the UK.
Mm-hmm. Yeah, UK is surprising to the upside. It depends where you compare to the last mid-year review or the year ahead forecast that we published in November. The two economies that surprised the most versus our year ahead were the US and India.
Okay.
India will revise a little bit lower the growth forecast, but it's an economy that will grow between 6.5% and 7% for many years. Japan is picking up. I come from Tokyo, where we had a very successful conference, and I think the mood is changing. After the slowdown in consumption, the market expect a recovery in the second half. The BOJ to continue normalizing monetary policy as wage inflation picks up. So it's a better story than what we have thought or the market 3-6 months ago.
Claudio, it's great to have you here in Hong Kong. Claudio Irigoyen there, head of global economics research at BofA. Take a look at when it comes to what to expect here. We talked about that stronger fix in the PBOC. Plenty more into your market check coming up. This is Bloomberg.
Right, welcome back. Just to recap the midpoint of the day, the PBOC setting it below the 710 handle, which is now the strongest fix that we have going back to April 15th.
Yep, and of course that really reflects the dollar weakness and maybe this yen strength as well, as our analyst Mark Cranfield is talking about that 1% surge on the yen. You're watching the China show. We're counting down to the opens here, and yes, stronger yuan story here. Hang Seng flat. This is Bloomberg. Welcome back. You're watching the China show. We're counting down the open of markets. There is a typhoon number 3 in Hong Kong right now. Looks set to be raised to a typhoon 8 possibly later on this afternoon. So definitely watch out for the weather here today. But really, when it comes to equities, it's a mixed picture across Asia. We're pretty flat in the pre-market in the Hang Seng here right now. But certainly a lot of moves in treasuries, a lot of moves in dollar yen overnight after that U.S. JOLTS data, Dave.
Yeah, I think that's a good point to bring up, because not a lot of people recognize, amid all the noise that we're hearing, and we saw, of course, from the AI trade, and of course, you had that massive drop in treasury yields. Not a lot of people actually acknowledged and appreciate how deep that drop in dollar yen was the last 2 or 3 days or so. And I guess in some ways, encouraging that we didn't see the sort of cross-asset malaise that accompanied a similar move this time last month. But simply just to say, dollar yen is back to levels of about August 5th. Right. Okay. As we look ahead to this Chinese market, which for the better part of the last 4 or 5 weeks has really lacked upward closes on the onshore market, right? So I'll give you a good example of this. The fact that we're trading below 28 on the Shanghai Comp and 33 on the CSI 300 goes to show really how far we've come, and that we've broken below some lines in the sand, so to speak. So one we're tracking is 31.79 on this index, and as you can see, we're about 80 points above that level, give or take. The reason that's important is because below that level, we hit a fresh 5-year low on the CSI 300. That's number one. And number two is when you look at the earnings story, it really hasn't given us a lot of sort of bullish options to digest, which is why you get the likes of JPMorgan now suggesting and abandoning their bullish call on Chinese stocks. So they've changed their overweight now. They were overweight. They're no longer overweight. The other thing I want to bring up, too, is as we flip the boards, too, it doesn't mean because this market is cheap and has been cheap, there are no opportunities. Bank of America actually put out an interesting recommended trade here. When you look at the Hang Seng China Index, which is at 61.45, as you can see on your screens. It's a called spread. I'll make it very simple. Because of how far and out of the money the trade is, it's trading at 108 is the price on that option. It rallies 13%, the index. That goes up to 500, so that's the return. Now, does it rally 13%? It's the question, given all the cuts in the growth outlook. Right. On the earnings story, just very, very quickly here, flip the boards, please. So you have two earnings out today, well, two major earnings. NEO is one. The other one is, I would, in my opinion, probably the bigger one as well, given the malaise that the New World Development guidance on their impairment caused within the sector. Of course, this is, I believe, Hong Kong's biggest property developer. 1.2% out with earnings today. Do we get something similar? Or even if we get something similar, has it already been priced in into that market? A rebound across oil and gold following the drop that we had yesterday. And of course, these were some of the sort of heaviest losses across the benchmark yesterday. Okay, very quickly, as we talked about how far we are on that specific level, just to give you a visual iteration of how that looks, that's about 3%, right? That's where we are. That's the level we're tracking. Below that, as we were pointing out, you're all the way back to early 2019 levels on the CSI 300. We had a massive bull run, of course, in 2020. That was accompanied by things like a pickup in margin debt, which, by the way, also, if you're curious, it's also near the lowest level here since February. And, of course, the drawdown, Yvonne, takes you now to 43%. Below that, 50%. We're about 6 or 7% from a 50% drawdown from the peak back in 2020, Yvonne.
Yeah, and I think if we continue this way, we're set for a fourth year of declines.
Yes.
When it comes to Chinese stocks. Not a good milestone. You take a look when it comes to analyst actions here today. We're focusing on the auto sector here today. So XPeng, those shares raised overweight at JPMorgan. So they're talking a little bit more about the upcoming new models in Q4 should increase quarterly deliveries from about 45,000 units in the third quarter to about 80,000 in the fourth. And you take a look at when it comes to Li Auto, though, an interesting call from Citi as well. They're talking about the worsening sales outlook for that car company, the car maker there. They're saying, look, aging models, rising competition, so they could be the culprit there. And Guangzhou Auto, 8 shares cut to a hold at DBS Bank with price target about 250.
Okay, back to the broader markets, and as we digest many of these sort of calls from analysts right now, the overall direction, of course, as we were pointing out, is down for this greater Chinese equity market. It's been quiet on the broader benchmarks here. Let's bring in Garfield Reynolds, who heads our MLive team and a coverage there, joining us right now to give us a context, Garfield, of, it was quiet 2 days ago, extremely noisy yesterday. It's quiet again today. What is your team writing about?
Well, we're looking very much at what are the risks heading into those payrolls that come at the end of this week, and we think that particularly for Asia it's a difficult week because you've got this massive event risk that's coming, and it's going to come after everybody here has already packed up and gone home. So the instinct, and it's not just the case for Asia, it's also the case for Europe, but the instinct is going to be, to some extent, well, we don't want to take a whole lot of bold positions when we're not sure what payrolls are going to bring. If we get anything like the severely disappointing print that we got a month ago, well then, okay, you're going to get those bets on 50 basis points from the Fed. You might well get both a decline in equities. Equities look like they're back to deciding that good economic news is good for equities and bad economic news is bad for equities. So That's a risk. And then, the yen looms over everybody. As you said, we're back at those levels, some of those levels we saw a month ago, but it's been a slow grind. And, we've got the safety net of having gone that far before and come back. What happens if the yen really gets rolling again?
Yeah, well, Garfield, before we ask you about the Nvidia and AI story, because that's certainly the equity component, since you brought up the yen right now, what we did see from the PBOC was the strongest reference rate 5.5 months. And that's actually leading to, as we speak, a further down leg in the dollar. So dollar Thailand, dollar Philippines, dollar Malaysia, dollar Japan. Are we likely to see more dollar weakness going through and into the jobs report tomorrow is my question.
The short answer to that is yes. Again, there's grounds for caution because in a lot of ways, I've been looking at this, a lot of what's going on, unless we get another outlier, the poor jobs report, the US is not really looking like it's in a recession. The Fed is not really treating it like it's in a recession. In that sort of a setup, you're more likely to get gradual rate cuts, more gradual than the market is pricing for. So this dollar weakness should persist into payrolls. Coming back out of payrolls, there's a risk that you get a dollar bounce back, similar to what we got, in fact, at the beginning of this week, because those Fed rate cut bets look overly aggressive.
And what does this mean for the AI trade? I mean, I look at Nvidia, we're basically down some 14% in the past 3 sessions, and it's just been a wipeout. Are we seeing any signs of when this pain might end for the stock?
Well, some people are resorting to round numbers and saying, $100 is crucial. Presumably, if it goes through 100, they'll say $90 is crucial. But the concern for the AI space is that it did, the run-up was so extreme, some of the valuations had become very extreme. People were seeing this as bulletproof, which is always a danger. That's helping to make Nvidia and some of the other AI names particularly sensitive to these concerns about an economic slowdown. The idea was that Nvidia shooting the lights out every quarter meant that the economies could power through because we had a new special driver, a new magic trick, as it were. That magic trick looks like people have decided they can work out how the magic trick was performed, and they're not sure that they're willing to be convinced anymore that the lady really is being sawn in half.
Garfield, thank you. Garfield Reynolds there, our Bloomberg MLive team there. And really sticking with Nvidia, the company has responded to that Bloomberg report on a U.S. antitrust investigation and saying that, dismissing, of course, that they have been subpoenaed by the DOJ. Let's get to our tech reporter, Annabelle Jewelers. She joins us now from Taipei this morning. Belle, what has Nvidia said?
Well, exactly as you say, they're rejecting the Bloomberg exclusive reporting that we had, essentially that Nvidia and other companies had been subpoenaed. So what we were saying was that it was a real escalation here, because in the past we'd been reporting on questionnaires that had been sent out to companies, and now they were going to be legally binded to respond. Nvidia has rejected it for its part, and it's saying that really the reason it has so much clout in the market really comes down to the quality of its products, and that's why it has such a strong customer base, and that's why it has such a strong order log. But of course, the regulatory scrutiny around the company does not seem to be disappearing anytime soon. The real question here is whether they've created an exclusive monopoly of sorts, where they're really making it more difficult for customers to choose other chips or to use Nvidia and as well other products in the market.
Yeah, Bill, and we were having this conversation yesterday, right? And the concern in markets is not so much is AI not a real thing, it's whether or not we've become over optimistic and some of the valuations have become too stretched. So when we look at a company like Nvidia, we look at TSMC to see how Nvidia might be doing, and you've taken that a step further, and you've actually spoken on the ground to TSMC suppliers to get a sense of how the broader industry might look in 5-10 years. And what's the sense you're getting?
Yeah, that's right. Really just trying to understand that Nvidia story from what's happening here in Taiwan. And we've been speaking to companies across the course of this week, but one of those is Scientech, and it's a major supplier to TSMC. It allows a special type of advanced packaging to take place. This is a new sort of area in the chip domain that's getting a lot of attention right now. But this is a company that has far outpaced the broader Taiwan benchmark. It's one of the best performing chip stocks this year. And I spoke to the CEO about why we have seen such strong numbers and his outlook for AI demand. Take a listen.
We are lucky in this AI industry. We benefit from the equipment that we build, the process that we develop with customers together to enable AI process. So that's why our investors value Scientech as a potential company who can really contribute in this industry.
And what sort of demand are you seeing? What's your outlook for demand for your equipment toward the end of this year, but next year as well?
The growth will be substantial for next few years. The growth rate will be much, much higher than 8%.
Can you give the number?
The equipment that we sold to them probably increase 2 or 3 times a year. It is possible. And so it is also benefit Scientech from their revenue.
Do you see any risk to that outlook?
From my personal perspective, this booming of AI industry just begin. There's a lot of application I do expect will coming out pretty soon. So that's why Jensen Huang, some time ago, he said the overall market of AI will reach 100 trillion at some point in the next probably few years.
We're seeing a lot of Taiwanese companies that are choosing to expand abroad. Do you see any sort of concentration risk from choosing to focus your attentions here?
Of course, definitely we will try to evaluate alternative locations, either for the R&D, for the manufacturing. Internally, this is under our processing.
Speaking more broadly now, what has been really capturing a lot of attention in the chip equipment manufacturer space or chip equipment provider space is the measures that we're seeing applied on Tokyo Electron and ASML and restricting sales of certain equipment to mainland China. That risk of tariffs or being prevented from selling to the Chinese market, is that something that concerns you or Scientech as a business?
My direct answer to you is no, because the equipment that we built mainly for packaging applications, and the packaging applications is not included in this limitation.
Do you see that risk ever appearing in the future? Is it something that you're looking at closely?
We all know the advanced packaging is becoming more critical every day. Most likely it will happen, but who knows?
All right, great interview there. Our tech reporter Annabelle Jewler is joining us out of Taipei this morning. And coming up, Xi Jinping is set to lay out his blueprint for growing China's relationship with Africa. We're live from Beijing next. This is Bloomberg. Well, President Xi Jinping is set to lay out his blueprint for growing China's relationship with Africa. Our chief North Asia correspondent, Stephen Ingles, joins us from Beijing with our next guest. Steve.
Yeah, we're just waiting imminently for that speech at the Great Hall of the People from President Xi Jinping. It'll be very interesting to see what his tone is. This is a hallmark project of Xi Jinping since he took office, essentially to engage with the African nations, yes, through the Belt and Road Initiative, but also to more recently really send a lot of the excess industrial capacity to welcoming Chinese or African nations, no doubt. But again, that has exacerbated some of the trade imbalances between the continent and China. And of course, we've seen debt loads amass in places like Zambia, Ethiopia, Ghana, and at least a dozen more African nations who are said to be in debt distress. It's not all China's fault, but again, the loans going forward are going to be probably dialed back. Let's discuss this more with Eric Olander. He is the editor-in-chief of the China Global South Project. So good to see you, Eric. I've known you for about 33 years. You know this relationship perhaps better than anyone in the world. Tell me, how should the relationship, given the economic downturn here in China and the debt issues in Africa, how must the relationship be adopted for the new realities?
Well, what we're going to see in the Xi speech is really the evolution of the Belt and Road into what they're calling the small is beautiful era. And so this is really in response to some of the debt concerns that you mentioned. We're going to see project sizes in the 100 to 200 million range focused on environmentally sustainable, focused on debt sustainability, energy, infrastructure. But more importantly, you're going to see Xi really take advantage of the moment that China is going to remain engaged in Africa, where the US and Europe and other major partners have been distracted by wars and the conflicts that are emerging in the South China Sea.
Do you think this relationship that Xi has pinned so much on has worked? I mean, I mentioned about how many of these African nations are indebted. We have a number of different case studies, whether it's in Kenya with a rail link that ends in a field. We have in Nigeria's capital essentially a light rail project that looks abandoned, is not really being used. Are these, from your estimation, isolated cases, or all across the continent do we have failed projects, or perhaps over-aggressive planning by the Africans who are already fiscally stressed in their coffers?
No, I think that's a vast mischaracterization of the debt situation. Remember that the Chinese account for only 11% of the African debt. When we look at the situation in Kenya, they're about 8% of the total. Don't measure on the bilateral because Africans don't borrow that much bilaterally. African governments tend to borrow heavily from their domestic markets, as in the case in Kenya and in Ghana and and certainly in South Africa. And so I think there's a vast overstatement of the role that Chinese debt plays compared to Eurobond and multilateral, which is much, much, much larger in scale and size. In terms of the Abuja Light Rail that you referenced, by the way, that is up and running now. And in terms of the standard gauge railway, that is a key mission for President William Ruto in Beijing this week to try to get the extension from Naivasha in the Rift Valley out to Kisumu on the Ugandan border. So this project isn't finished yet, and I think it's too early to kind of say that these are failures.
How do you think the global pursuit of influence within the Global South, in particular with Africa, is paying off for China at the expense of the West and the United States? Some of the deals that are being announced already here is landlocked nations. I think Zambia has renegotiated a deal that Mao Zedong struck back in the 1970s, essentially to complete the rail link out to the sea to the east, I believe. But the United States, to its credit, is also working, I think, with the Democratic Republic of Congo to build a rail link as well to the coast to the west. Who's winning this influence battle in the African continent? I think I know the answer.
Yeah, well, here's the thing. I mean, this Tazara deal, I think when we look back on FOCAC, is going to be, I think, one of the major highlights of it. So this is the railway that the Chinese built in the 60s. They have $1 billion public-private partnership plan to refurbish it. There was a signing ceremony this week with Xi Jinping and the presidents of Zambia and Tanzania. But this is really a direct response in many respects to the Lobito corridor that the U.S. helped to finance and to refurbish in Angola. Now, if you are going to ship resources to China to be processed, because remember, the U.S. and Europe do not have the processing facilities, are you going to go via the Atlantic or are you going to go via the Indian Ocean? And so the fact that the Chinese may build a competitor to the Libido corridor, if I was in the State Department in the U.S. government, I would start feeling very nervous about this investment that I've made in Angola with the arrival of a refurbished Zara railway. The competition is real and it's heating up.
Eric, how measurable is the battle for influence essentially in places like the UN as we have a number of different hotspots around the world, whether it's the war in Ukraine, the issues with Hamas, obviously you have tankers, super tankers in the Red Sea being attacked by Houthi rebels. You have a number of issues, hotspots. How much does this, forget the $120 billion in not well-performing loans that state policy banks have lent over the years to the African nations, but they've won influence in these multinational organizations, have they not?
Absolutely. And just you want to see this, how it's playing out. Take a look at the joint statement between Xi Jinping and Cyril Ramaphosa, the South African and Chinese presidents. They mentioned Gaza by name on multiple occasions, and China praised South Africa for bringing the issue to the International Court of Justice. So this alignment between China and Africa on these issues like Gaza, on colonialism, and on opposition to a lot of the Western-led initiatives in places like Ukraine is very powerful, and in many ways, China has been benefiting enormously from Africa's support.
Eric Olander, we've just scratched the surface. I wish we could go on and on and on. We have to catch up as well. Old times, 33 years now, friends. Eric Olander, editor-in-chief of the China Global South Project. We have more, obviously, coming from Beijing here as we're awaiting the keynote speech, the welcoming speech. A lot of pomp and circumstance happening at the Great Hall of the People. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI a half hour into the session. Doesn't look like it's a Typhoon 3, but it really is right now. And things could get worse in the next 24 hours or so, according to the observatory here this morning. But yeah, equity markets not looking too favorable either. I guess you could say we've reversed some of the earlier gains here. We're just down about 0.1%. Of course, we're still kind of talking about that JPMorgan call, really abandoning that overweight position when it comes to Chinese stocks. They're more neutral now on some of these trade risks as well. BofA also cutting their growth forecast. I think one of the last to really go and really cut their forecast below that 5% growth target.
Yeah,
too.
Goldman Sachs 4.9, BofA is 4.8, and the list goes on. And I think most, if not all, the major banks, and I'm hedging that because there might be another bank, I think HSBC, I don't know what HSBC's call is, but most of them effectively have downgraded and now think that China might actually miss that growth forecast. More on that in a moment. Now, to the slower growth story that we're hearing globally, is, you know, on the BofA point, right? They did a 3.3 to 3.1% cut on global growth. A lot of that is China, but also the soft landing that they expect still in the U.S. And that is the debate right now. You know, how large this Fed rate cut needs to be in September. The entire curve actually shifted substantially lower overnight. Yes, we're seeing a little bit of a pickup now on the short end, but suffice to say, we're back to levels of 2022 on the short end there. Asia Pacific, amidst the, I guess in many ways, this calm ahead of the storm, in between the storm we had yesterday, and maybe we'll see what the weekend looks like. 0.5% to the upside. Most of the equity markets are rebounding off the lows that we had yesterday, with the exception of Japan, as you can see on your screens. There certainly is a buy on the dips price action we're seeing here on the Kospi and the TAIEX, which were some of the worst hit yesterday. Jakarta's coming online, 0.3%. The story, though, is really what we're seeing in the FX markets, with it move down in dollar yen that we saw yesterday.
Yeah, it was more than a 1% move, just given that softer jolts data that we got. And it just means, like, you know, if we see another weaker print in the jobs report on Friday, what does it mean for dollar yen, right? Are we starting to see more of this unwind of this yen carry trade once again really happening? And really, the dollar, we continue to see it edge lower here, and that fix that we saw from the PBOC certainly reflect that. I think that 709 handle, that certainly is a milestone we haven't seen for some time, the strongest fix since April from the central bank. So certainly we're watching EMFX very closely, also across the G10 space, but there you go. You are seeing strength across Asia, Taiwan dollar, peso, ringgit here this morning as well.
Yeah, I think about an hour back we did get an update on inflation out of the Philippines, and this inflation story is continuing there and some of the commentary coming through. So I guess in many ways, almost everywhere you look, with the exception, I guess, of Japan, there are signs of a cooling of many economies, right? So from the job market, the jolts that we had, of course, overnight, going into the job market right now, and of course, how large does that cut need to be? And I think
how high of a bar is it for 50 basis points now?
Yeah, and I think it's quite high, is the comment coming
It's lowered overnight, though. You take a look where Fed pricing is now.
Oh, certainly, yeah. And I think we're now looking at 10 cuts.
Wow.
Between this upcoming one and, I guess, to the end of the cycle, which is mid-2026. The other thing, of course, overnight was yesterday was the cut out of also the similar bank, 4.8%, right, from 5.
From BofA.
BofA, yeah.
Overall growth was cut from 3.3 to 3.1, but what really dragged that was their forecast in China, right? Yeah. So basically 4.8% from Helen Chow and her team. There you go, as we talked about, right? It's basically a 4 handle for most of these banks here when it comes to growth for 2024. Earlier, we did hear from BofA's head of global economics research, Claudio Irigoyen, on his China outlook.
When the market becomes too pessimistic about China, you have to take into account that the further the slowdown, the more likely the reaction function of the government, and then it's when you have the positive surprises. So you have to monitor all the time, high frequency, how the economy is evolving and how authorities might react to the slowdown of the economy, because they have room to do more.
Mark Cranfield is with us right now, out of our MLive team, out of Singapore. Mark, bad news has been bad news for markets. How do you think things look ahead of the jobs number on Friday?
I think it's a bit asymmetric, really. I think investors are getting frustrated that the Federal Reserve already appears to be behind the curve. Those JOLTS numbers are not helping the situation, of course. And they really are clamoring for a bigger interest rate cut in September, which they're probably not going to get. All the Fed speakers, the suggestion is that they want to lower rates, but probably only by 25 basis points. And if we get another soft US employment report this week, then people will really be going overboard, expecting there'll be 50 basis points, and yet there's very little chance of them getting it. So the market reaction is probably going to be somewhat negative, and particularly towards the equity market. They're the ones that will probably take it on the chin the most. Now, if for some reason with the flip side, we actually get a better than expected jobs report, the upside gains for that is probably quite limited as well, because what will happen is you get a reversal in the treasury market, yields will go back up a bit, equities won't like that too much, the dollar will probably go a little bit stronger again, bit of a headwind for equities, and then you'll go back to the same scenario where people are thinking, well, the Fed is still behind the curve anyway, because so much other data has suggested, the Fed Beige Book as well that came out this week also suggested that the economy is slowing more quickly than some of the other numbers expect as well. So it's almost like a no-win situation for equities, particularly when you look at the technical picture, which is even worse, because the rebound that we had in August for both the S&P and the NASDAQ didn't go as far as the July peaks, which from a short-term trader's point of view is bad. They don't see much in the way of gains from that point of view. So we're going into the market here on Friday with people very skewed towards looking for reasons to sell the market again, and it's pretty unlikely that we can get anything that will change that around.
And certainly when it comes to the biggest FX play at the moment, it is the yen, right? Just given what we saw overnight. We did see some of the comments from Takata-san from the BOJ, which did temper some of these gains, but what's happening here right now?
Well, this morning we had the labour cash earnings again beating expectations on the upside. We've had Governor Ueda putting in writing the fact that more policy tightening is coming ahead. Enough signals are coming from the Japanese policymakers that more tightening needs to be done. They're going in that direction, most likely in October. All of that is positive for the yen. The carry trade unwind has probably gone most of the way. We're actually now tipping to the point where the yen is beginning to get some haven status back. And so it's a positive now. It's a self-reinforcing positive that as we get equity market disturbances, is actually good for the yen. Plus, of course, Treasury yields have been sliding this week as well. So the yen is beginning to gain ground from a variety of factors, and it can probably go a bit further. Look at the fixing today from China. It's almost an acknowledgement that dollar yen is going to go lower. There's not much we can do about it. Let's not waste our bullets on the fixing today because we're going to need more ammunition in the weeks ahead.
All right, Mark, thank you. Mark Cranfield, our Bloomberg MLS strategist, joining us out of Singapore. Well, President Xi Jinping is addressing a forum with African leaders this hour and really laying out his blueprint for growing China's relationship with the continent. Let's get to our chief North Asia correspondent, Stephen Ingles. He joins us live from Beijing. And Steve, what are we likely to hear from the president today?
Well, he's going to be outlining the importance, obviously, of China's relationship with all of Africa, all the African nations, as is, through his signature project of the Belt and Road Initiative that we've seen about $120 billion worth of state policy bank loans into Africa. Yes, a lot of them have not performed well, and there's been a bit of a revisiting of the amount of money. So perhaps any new loans going forward could either be scaled down in size and also expectations, and with more emphasis on returns on those investments. They could also shift to more PPP, public-private partnerships. That would allow cash-strapped African nations to essentially take these loans, and also they wouldn't exacerbate the officially declared sovereign debt numbers. So again, there's ways to tweak this, and I think coming out of the pandemic, where there was severe cash crunches and fiscal crises at a number of countries in Africa, including 3 that defaulted. That's Zambia, as well as Ethiopia and Ghana, and more than a dozen other African countries that are nearing debt distress. There has to be a little bit of a rethink. So that's what we're hopefully going to get from Xi Jinping on what his priorities. But there's no doubt he has won influence within the African nations, which are a big part of the so-called global South. And that has won influence as well with African nations on issues at the United Nations that are favorable to China. And that is also, if these investments are not providing returns, the influence has provided quite a bit of returns.
Yeah, and Steve, David here, remind our viewers, Steve, why, to your point, in terms of just the big picture, why this is China's largest diplomatic event of the year.
Sure, because Xi Jinping clearly sees that the lines of influence and power around the world are being redrawn, if you will, not in pencil with an eraser, but with permanent marker. And one exception, perhaps you could argue, is the Global South. Now, the Global South extends from the Indian subcontinent through Southeast Asia to Africa, as well as South America. Supposedly many non-aligned nations which have a lot of clout as far as their resources that China obviously wants to have. They also need investment in badly needed infrastructure. China has provided that to Africa. Yes, the debt situation is bad. Yes, it's an imbalance of trade. But I spoke to the Djibouti foreign minister yesterday, and he said, no one is trying to say that this relationship is balanced. It's not. But they need the cooperation from China. And look, Xi Jinping knows this. Xi Jinping is looking to win friends and influence decisions on multilateral basis in places like the United Nations. And he has been to Africa 5 times over the course of his last decade in power, decade plus. How many times did Donald Trump and Joe Biden go to Africa? 0 over that time frame.
Steve, thank you. Stephen Ingles, our chief North Asia correspondent there, highlighting really just the importance, significance, this from a global context, what's going on there at the capital. Right, just ahead here and shows to the other big China story we're tracking today, and the tweak to the grand plan perhaps in the offing here as it pertains to the property market, China considering lowering mortgage rates to achieve an objective of stabilizing the property market while protecting the banking system. The details just ahead.
All right, we are just waiting for President Xi to continue with his speech at the Forum on China-Africa Cooperation here. He's talking about elevating ties with African countries to a strategic level as well. And of course, we were just stressing how important this really diplomatically is for China here at having this big event.
Yeah, and really against the backdrop of a domestic economy that still is sort of lacking in terms of demand. And really, China has been looking out for drivers of growth, and certainly exports is really one part of that. And maybe, of course, and we had a look at this week, right? So out of the 10 largest African economies, China's the #1 trading partner of 6. It's within the top 3 of the next 4. So the significance of this is quite telling. Back to the domestic economic story we just highlighted there. Some of the property stocks up and running about 45 minutes from now. Not really seeing a lot of reaction to the reporting that we've done at Bloomberg this week on we're looking at refinancing and maybe also China's weighing cutting some of these mortgage rates. And really the problem on one chart for you coming up on your screens is that while banks are being asked to lend out, if they lend out, they're either losing money or there's not a lot of margin coming through it. In fact, when you look at net interest margins, it's below the threshold that would be necessary for reasonable profitability. Now, Bloomberg Economics doesn't think that the potential mortgage cut will revive housing and demand, while Bloomberg Intelligence sees the squeeze to the banking sector might exacerbate even further. Let's bring in our economist David Chu and our senior analyst Francis Chan on the banking system. But David, let's start with you on the economy, and you still have your doubts that this might or can work.
Well, we cannot say it won't work, but for me, I think if we see anything effective, I think it should be marginal, because this is what we learned from last year's experience.
How much do you think it could lift household consumption, for example, or the housing market?
Well, it's very hard to say how much consumption it can lift, because we can only say, okay, this can save the households' interest payment almost 300 billion yuan per year. But we don't know how much of this 300 billion yuan can be transformed into consumption, because we have seen that the households has been conservative in spending over the past couple of years because of the uncertainty over the outlook of the economy.
But doesn't it help more than it doesn't help? In other words, right? In other words, if you relieve the burden or you reduce the burden to take a mortgage out, doesn't this help in some ways?
Yes, it can help. Well, at least it can improve households' financial situation, right? Or in other words, it can lighten the debt burden. At least on this aspect, that is good. But still, we cannot calculate accurately how much it can help the economy and the consumption as a whole.
What does this mean for the banks, Francis?
Well, obviously, lower profitability. A plain vanilla calculation, you log off 0.8% of the loan yields from 37.8 trillion or 5.3 trillion US dollars of mortgages. It will be like 300 billion yuan. And for the banks I cover, it's disproportionately big. The profit hit or revenue hit could go up to 237 billion. And that will be equivalent to a 10 basis points decline in net interest margin on the annualized basis. Of course, that would be like a one-size-fits-all approach. If the regulator will take time to ask the banks to allow refinancing of those mortgages. We do have our case. We do think only half of those could be repriced maybe over the course of the next 18 months. And the hit will be like 4 bips, or the actual impact will be 104 billion.
What is you mentioned one size fits all. I'm curious, do you have an estimate of what funding costs are for the sector?
Well, funding costs has been edging lower and lower, especially for the banks that have been cutting time deposit rates very aggressively over the past 2-3 years.
Right.
Now you're talking about lower than 2% for the 5-year time deposit. You don't hear about a lot of those in other markets, but in China they do fix the term deposits at those durations. But if you take a look of what the asset yield front the banks are facing, even if they try to hold more bonds in the market, bond yields have been edging lower and lower. So not only about loan yields.
David, do you expect then that we're going to see more policies supporting family and the housing sector?
Yes, we do. Actually, the government has issued the cash for clunkers schemes in several cities and provinces. And, well, I think in next month's data, we will see the supportive effect from this. And in addition, we think that, but still, we don't think it's enough. And we still think that the government should issue more policies to help the households. Well, we cannot target a specific series of policy, but we do think that is the direction in the near future.
All right, David Chu, thank you from Bloomberg Economics. Also want to thank our Francis Chan there from Bloomberg Intelligence, who covers banks for us, on the impact of these reported possible mortgage rate cuts as well. We're going to leave you with those live pictures out of Beijing, of course, from that China-Africa summit there, and President Xi still making that speech this morning and saying that China is ready to help Africa in building capacity to safeguard peace. Of course, the latest headlines from his opening speech at the forum. We have plenty more ahead. This is Bloomberg. Some stories we're tracking for you this morning. Nvidia shares fell a third session in New York, now down around 14% since last week's earnings outlook disappointed investors. Meanwhile, the company says it is in contact with the U.S. Justice Department, but has not been subpoenaed. That's in response to information from Bloomberg sources saying the DOJ had served subpoenas as part of its antitrust investigation. Couche-Tard says the weaker U.S. economy may improve its prospects for making a large acquisition. That statement was released alongside the Canadian convenience store operator's first quarter earnings results. But it made no reference to its interest in Seven & i Holdings. An agreement for Seven & i would be the biggest ever foreign takeover of a Japanese company. All right, there's a market check here right now. We're watching in particular the casino and travel space in Korea. So this is what we're hearing here, that Gangwon Land gaining approval from the Culture Ministry to expand its operations. So that casino operator now licensed to expand the size of its business establishments. So you're seeing tour groups, you're seeing airlines all rallying on that news here today. And yes, there you go. Gangwon Land itself is up close to 8% in Seoul right now. In terms of China benchmarks, this is what we're doing, and this is how things are looking at when equity markets are actually doing okay. And really seeing some rebounds in some markets like Taiwan, for example. China is doing this here right now. We're pretty much flat for CSI 300, Hang Seng as well. MSCI China is slightly lower here. You're not catching a bit of HS Tech. We're pretty slow going. It doesn't seem like people are really willing to put much money here into this market. Of course, we're still kind of dealing with the earnings season, which really has been quite disappointing, Dave.
Yeah, it really has been. I mean, the bad news has been taken as bad news by the markets, and the good news has been it had to be really, really good for markets to act. And once markets did see some silver linings, they acted in it, but sold very, very quickly. So I mean, it's been really, really wanting in as far as sustainability of this rally. And I guess part of it is September, part of it is we are entering a rate cut cycle, and part of it is we still don't know. And while the bar is maybe high but lower compared to yesterday for a larger cut from the Fed, that underscores that markets are trying to figure out how quickly the data continues to deteriorate in the U.S., which I guess is net negative. And I think also why we're looking at, when you look at the FX markets, the tendency for markets is to sell the dollar in favor of a lot of these EM currencies, which, by the way, it's not really leading to equity flows back into EM, which is another problem that's all, forming altogether.
Yeah, you got to wonder if the China factor is what's limiting these flows back into the EM space as well. But we have seen many guests on this show talk about, you have to kind of single out the China story and look at EM overall. Our next guest, Hiren Dasani from Goldman Sachs Asset Management, certainly feels that that's the case. In particular, take a look at India, as he thinks could be that sort of anchor in the emerging market space. To, for anyone that wants to look back into EMs and is still wary about what's going on in China, India could be that safe spot. So certainly we're going to talk to Hiren Dasani about that as well.
Yeah, one of the things that he's been that supports that view of it. So you know how we talk about uncorrelated markets in the global cycle. So China is one, India's another one too, on the other side of things, because of domestic flows, because of the retail investor base, and because of the inward-looking nature of the big plays in India. We're still looking at pictures out of Beijing. We are, of course, still continuing to track the conference there. And, of course, the Chinese President Xi Jinping has been speaking there, and some of the news lines coming through as well as we pan into the Chinese president and some of the leaders there from Africa in the capital.
Just want to recap you on some of those lines that we're hearing from the president there, kicking off and with his speech with the China-Africa summit. And we're hearing a little bit more about what could be in store in this partnership, of course, with 50 nations there from Africa. Listening to the speech here this morning, he says China willing to expand market opening up to African countries to encourage Chinese firms to invest in pharma in Africa as well. And they strive to create at least 1 million jobs in Africa here right now. And they even were talking about the tariff benefits, that China could give 33 African nations 0 tariff benefits there.
Yeah, speaking of lowering the barriers to entry and the flow of goods, right? So, I think in many ways, Stephen Engel, our chief North Asia correspondent, who is in fact there at the conference, highlighted this very, very well, right? Amid this, the courting of the global South and and the blocks of economies there, China's really looking at this as an opportunity to strengthen those ties. And I think some of the sensitivities around debt burdens and some of the defaults that we've seen out of several African economies and countries, that's a difficult conversation to have, but a necessary one, given what's taking place outside these blocks of economies. We'll bring you the latest once we do have more, of course, from this ongoing summit taking place in the Chinese capital. In the meantime, back to the here and now. With markets, the story today, in the absence of price action in the equity markets, is really this rally we're seeing in bonds and the drop we're seeing in the U.S. dollar. And as you can see, dollar-yen, of course, if you're wondering why we're at 143 right now on dollar-yen, blame the softness in the dollar and blame the hawkish commentary coming out of Japan this last 48 hours or so. That's your story across the majors. EMFX is really where we're seeing the pronounced moves here, whether that's dollar China, dollar Taiwan, dollar Malaysia, and of course the Philippines, where we had softer inflation numbers coming through as well. So again, we're back to this cycle of money moving back into EMFX, but not really moving into the equity markets. Okay, what else are you seeing here as far as the fix is concerned?
Yeah, it was the strongest fix we saw since April, right? So obviously reflecting that dollar weakness, but also just reflecting the yen strength that we've seen, that in some ways the central bank is kind of letting the currency ride along with this yen strength here this morning, given that it was the first time in a while we've actually seen a fix below 710, right? So at 709. So pretty close to some of these spot levels here right now. And that's really helping the renminbi continue to strengthen here this morning. And it's really kind of leading to Asia FX to also strengthen along with it there. Look at Taiwan dollar. Look at the Malaysian ringgit, for example, as well, Dave.
Yeah, and that takes us now into, what our strategists now saying about, while we over-obsess over the Fed, and as we rightly should, really in many cases, right? So we've been dealing also with the very cheap Chinese equity market, right? And, one of the top stories, Yvonne and I have been tracking this last 90 minutes or so, is, well, number one, JPMorgan coming out and abandoning their bullish call on China. BofA came out with a slightly more nuanced approach to these cheap valuations, and they're saying it's a call spread on Hang Seng China. If the index rallies 13%, that could pay off because the options prices are extremely cheap because of how out of the money we are. 108 gets to 500 if we get that rally. Now, does it rally is the question. So the premise is cheap Chinese stocks. MSCI China, forward multiple, we're back to 1 sigma below the historical mean. That is in and of itself as an index. Right. Let's compare China now to the S&P 500, where there's a separate conversation going on there with multiples to the upside being pulled higher because of the Mag 7. Now, the ratio between the S&P forward and the MSCI forward is now at 0.42. In other words, China's trading at 40% the valuation of the S&P 500. And not only is it at 40%, it's also, when you compare that ratio to history, it's now trading very close to 2 standard deviations below the historical mean. So it's statistically cheap, and it's an aberration, I guess, in many ways, given how cheap and how depressed these multiples are in this Chinese equity market, Yvonne.
Yep, and it really hasn't changed, though, right? That valuations haven't really brought people back into this market in a big way. It's great to bring in our next guest here. Perfect guest to really talk about the outlook for Chinese stocks. Hiren Dasani, co-head of emerging markets equity at Goldman Sachs Asset Management. He joins us live from Singapore here this morning. Hiren, it's great to talk to you. As Dave kind of highlighted there, I mean, you take a look at most of these benchmarks in China. We're basically heading into a 4th year of declines. The macro picture, the earnings picture has been pretty disappointing, to say the least. You have delistings that are shrinking this market. IPO market hasn't come back in a big way. Given all that wall of worry right now, what is your long-term call on China?
Thank you, David and Yvonne. Good to be here again. And let me just share some of the thoughts on China, how we are thinking about it. So, first of all, there is a great value today in China that is undoubtedly clear. And as you were just highlighting, the multiples are quite cheap. So valuations are in your favor. Now, there are macro headwinds, but from a micro perspective, companies are doing what they are supposed to do. And what I mean by that is they are cutting costs, they are focusing on profitability, they are doing shareholder returns, they are increasing the dividend payouts. So all the shareholder-friendly measures which you can think of, we are looking at many Chinese companies doing that. So you have this, kind of push and pull between a tough macro environment and very favorable corporate actions. So how we are approaching China, we are doing it obviously stock by stock on a bottom-up basis. And we do find selective opportunities with companies who are doing the self-help and companies which are in a much better competitive situation across the sectors.
Okay, Hiren, I want to get your thoughts on, and we'll talk about India a lot more in a moment, but I want to get your thoughts on, there's been a rebalancing, of course, and MSCI is a very good example of that recently, where the weighting of India is almost at the weighting of China. And I wonder whether you think, number one, it's inevitable that India deserves a bigger weighting than China. That's number one. And number two, what's your vision on the role of China in global portfolios structurally moving forward? Has that ship sailed?
So let's look at the numbers, right? So in the MSCI emerging markets today, China is at about 24-25% weight, and India is close to about 20% weight. Now, in terms of the size of the economy, in terms of the size of the market, obviously China is still far bigger market than India. And but from a growth perspective, what we are looking at is that China GDP growth will be somewhere in the range of 4%, at least in the next 3 years or so, 4 to 5%, call it. And then it is quite consensus that there is going to be gradual deceleration in the growth of China. So from a medium term, nominal growth of mid to high mid single digit maybe for China, and compare that to India, where the nominal GDP growth is going to be double digit for a foreseeable period. So there is a almost 6 to 7% difference in the nominal growth between India and China if you look out over the next five plus years. And in the case of India, obviously currently the corporate earnings are in a very good cycle. So corporate earnings are growing at about mid to high teens in India. But if you look at the longer term picture as well, corporate earnings have grown very much in line with the nominal GDP for India, which is at double digit rate. So obviously markets are going to price higher earnings growth, less volatile earnings growth in a more favorable way. And we are constructive from a medium-term perspective on India because of the strong earnings growth story.
So here and again, comparing the two, that's a very good point you bring up. I mean, India's trading, let's say, 20, 21 times earnings. China's trading at 8. Arguably could say China's trading cheaper than its fundamental value. India's maybe slightly the opposite. Between the two, what do you think is further from its own fundamental multiple?
Yeah, I mean, we'll never make those one versus the other kind of comparisons, David, and we are very bottom-up stock-picking team. And we'll try to find the best ideas. And so in our portfolios, both China and India, we are somewhere around the benchmark weights in our portfolios for both China and India.
Okay. For China, there still doesn't seem to be any sign of a turnaround right now, Hiren. I'm just wondering, where do we go from here? What would it take to really end this sort of downturn in Chinese equities?
Yeah, so as I said earlier, the companies are doing what they are supposed to do. We would definitely need a little bit of more top-down support from the macro perspective. And what I mean by that is that, the policy actions so far are all in the right direction. But what the market wants is probably the quantum of the fiscal easing, maybe more support on the consumption side. So those are the kind of policy actions which the market is looking forward to. And we also need to get through this period of the US elections, which are going to have negative headlines around the Chinese equities and the US-China relations. So my sense is that once we get past that event, and once we get past the rhetoric of the elections, and we see kind of more supportive, more in quantum the policy reactions from the fiscal and the monetary perspective in China, those would be the kind of top-down reasons where the market can potentially look at turnaround over the next 6 months or so.
Hiren, and on the appropriate exposure now to the India story, it's a very big market. Large caps have done well. Small caps have done well. Where would you lean into exposure there? And I'd also just want to tell our viewers, too, like when you look at small caps, for example, Hiren, that looks like a party at 3 a.m. and someone's about to bring the tequila out. It's up 500%. And I'm wondering, are there pockets of this Indian equity market where maybe you're a bit wary of?
Yeah, I would say party is very much in force. And I don't know whether it's 12 a.m. or 3 a.m., but the party is definitely supported by the very strong earnings growth. So let me put some perspective there. If you look at the MSCI India earnings growth, it's about 20% or so over the last 4 years post-COVID. And if you look at the MSCI Small Cap India earnings growth, it is almost 40% CAGR, almost twice the earnings growth of the large cap. Look at the forward 2 years, the headline earnings growth is about mid-teens or so for India, and the small cap earnings growth is forecast at about 22 to 25%. So my limited point is that earnings growth is much stronger in the small cap. Yes, there is definitely going to be some froth and speculative activity in parts of the small cap, which is not unusual when the markets are that strong. But by and large, the manufacturing competitiveness which India is witnessing, or this whole supply chain diversification, premiumization of the consumption, infrastructure story, all of that, you can see many more companies in the small and mid cap space than in the large cap space, which are benefiting from that. And then finally, I'll also point out to the very strong domestic flow environment, right? So just to put things in perspective, year-to-date foreigners, in spite of all the positivity about India, have only bought stock worth $3 billion. The domestic guys have bought almost $37 billion. And domestic guys are obviously going to be more familiar with the mid and small cap. So there are structural reasons of growth, and there are obviously flow-related reasons as well, which are supportive of the small and mid cap.
Hiren, it sounds like you're ready to keep partying on. Past 3 a.m.
Yeah.
All right.
Watch out for the sunshine, though.
Go ahead, emerging markets equities at Goldman Sachs Asset Management. Plenty more ahead here. Thanks so much for the time, Hiren. This is Bloomberg. All right, we are checking Nippon Steel shares. This is how we were trading, of course, before that lunch break. And we were actually heading higher here by about 1.5% or so. What we did hear from President Biden, said to be preparing to block Nippon Steel's $14 billion takeover of U.S. Steel. And sources say a decision could come as soon as this week. Let's get to our Tokyo Bureau Chief, Isabel Reynolds. She joins us now. So, Isabel, does this spell the end of this deal?
Well, certainly both sides on the corporate side are refusing to acknowledge that. We've already had US Steel and Nippon Steel both come out with statements quite strongly saying in the US Steel's case they will pursue all sort of legal avenues to make sure the deal goes through. And then on the Nippon Steel side, underscoring their case that this deal would pose no threat to national security. So therefore, there is no reason to block it. And they're hoping that the US will look at this in purely legal terms and do things by the book. That doesn't look like it's going to be what happens, and it would be highly unusual, obviously, for any litigation or any company to be able to overturn a decision made by CFIUS or indeed by the President of the United States.
Isabel, I thought the U.S. and Japan were best friends. What does this say about that alliance between the two, and what's the reaction that you're hearing and seeing from the Japanese side of things?
Right. Well, certainly this decision will be sending shockwaves through Japan. Japan does view itself as one of the closest, if not the closest, allies of the US. And indeed, we have a meeting coming up probably later this month between Prime Minister Fumio Kishida and President Biden in New York, at which this will be a very awkward sort of subject on the table. So, yes, it will be sending shockwaves through Japan. It will raise eyebrows in other parts of the region. We have seen China in the past sort of making fun of the US for being sort of somewhat protectionist about its industry in a way that is criticized China itself for doing. So it's a very awkward situation. Japan won't make a very public fuss about this. I don't think they're very anxious to preserve, obviously, the defense relationship, which is hugely important for Japan. So any criticism, I think, will be kept largely behind the curtain.
With limits friendship. Isabel, thank you so much. Isabel Reynolds, our Tokyo Bureau Chief, on this very sensitive, of course, and complicated relationship between corporate and government. All right, in other news this morning, Bloomberg has learned that Samsonite has selected two banks to help arrange its dual listing in the U.S. Now, our sources say it's working with JPMorgan and Morgan Stanley, with other lenders also joining or looking to join at least the lineup here. Samsonite, of course, trades here in Hong Kong and is also said to be considering the U.S. for its primary listing to become more accessible to global investors. Now, Blackstone has agreed to buy AirTrunk in a deal valuing the Australian data center operator at about $16 billion, that's US dollars here. The deal also includes debt and capital spending for committed projects. If approved, it would be Blackstone's biggest ever investment in the Asia-Pacific and one of the biggest global deals this year in digital infrastructure. Now, HPE shares fell in extended trading here. The company reported weaker than expected margins here. I mean, its adjusted gross margins stood at nearly 32% in the fiscal third quarter, marking a decline from a year back. This suggests lower than anticipated profitability in its closely watched AI server business. Okay, that's a wrap of deals and earnings. Plenty more ahead. This is Bloomberg. Okay, straight back to Beijing and live pictures of the ongoing conference. Of course, there are a couple of headlines coming through so far and some fairly clear takeaways as it pertains to, I guess, the amounts involved. So China will be providing 1 billion renminbi in military assistance to Africa. That's from the speech of the president, which wrapped up the Chinese president, to be more specific, wrapped up a few minutes back here. Also, China will be giving Africa 360 billion yuan in financial support over the next 3 years or so. A 210 billion credit line also over the next 3 years, and China will be striving to create at least 1 million jobs in the continent. That's, I would imagine, roughly around the same time period.
Yeah, that blueprint on how to really deepen this relationship. Yeah. We're hearing that here this morning. More now from, of course, that China-Africa forum in Beijing. And Djibouti's government says it has high hopes for a boost to relations. The foreign minister, Mohammed Ali Yusuf, told us exclusively that a strengthened economic partnership will be mutually beneficial for both sides.
We know that today, China has maybe not the same capacity, despite the fact that the willingness is there. We are living in a polarized world. There's something coming in the international arena. The African Union is trying to position itself. Now, we will certainly adapt to the new conditions that we are faced with. African countries have each one specific needs, specific expectations, but the priority should be to focus on strategic partnerships. When it comes to peace and security, we have an African architecture for peace and stability. We expect from China that China will support that architecture, specifically the Peace Fund. We also expect that China will step up in its support financially for the modernization of the plan that Africans set for themselves in terms of agriculture and so on and so forth. I think this is a two-way partnership. Of course, we know that China expects also a lot from the African continent.
They want better returns. Obviously, they've gotten minerals and they've gotten energy through their partnerships, through their 120 billion plus that they've invested through state policy loans. Yes. But they also want returns. So are you finding perhaps for African nations, the wallet is a little slimmer and it's not opening as wide as years past?
I'm not saying that the partnership is a balanced one. But we have to also recognize the fact that China is now one of the biggest industrial products producing country. It needs market. It needs, partners on the African continent. It needs minerals and natural resources. China has a boiling economy. At the same time, we also feel that we can take our own advantage of that partnership when we speak as a united African countries.
And that was Djibouti foreign minister. They're speaking, of course, with Stephen Engel there at the sidelines of this ongoing conference in Beijing. Right, back to some data that came through in case you missed it across the region today. Let's start things off with the Philippines and a look at the peso, a look at inflation, which came in a lot softer than the median estimate. And the guidance seems to be from the central bank that it is headed in the direction it wants. Keep in mind, they did cut interest rates at their last meeting. And the next meeting that's coming up, I believe, in about, 5 to 6 weeks from now, certainly strengthens the case for them to follow up. But, of course, there is a long time between now and, October 17, when the next Bangko Sentral meeting will be taking place. Aussie trade numbers also came through about 90 minutes back or so, coming in 6 billion Aussie for July. 5 billion was the estimate. We are seeing a pickup in the Aussie dollar. Might be on the back of the drop in the dollar more so than that beat that came through as far as exports go. And just very quickly before we go, a look at earnings and some of these Hong Kong developers that are set to report today.
So finally seeing a bit of rebound, at least after 3 days of declines on the Hang Seng Property Index after what we heard from New World with that profit warning. So you are seeing signs of maybe people are buying on this dip here. Sunong Kai is up about 2.3%. They report earnings later on today.
Yep. Alongside, if the weather cooperates here, they might be reporting alongside maybe a T8 signal being voiced in the late afternoon. So both possibly after the market closed today.
Time to stock up. This is Bloomberg.